When you look at a past chart, you could easily find support and resistance areas, find a trend, add some indicators, and think about how easy it is to use technical analysis. But in real time, when the next bar has not been printed yet, things are much different. Today we'll talk about the realities of technical analysis and how to correctly approach trading. So if you could, like, subscribe to the channel, and stick around for the full video. If you are striving for perfection in trading, you're going to have a hard time. Consider trend lines and support and resistance. If you are expecting the price to turn right at the exact point on the chart and base your trading decisions on that exact line, good luck with that. These perfect right to the P patterns are seen only in trading manuals. In real time, price movements can be quite messy. If the price dips a little bit below a support line, it doesn't necessarily mean that the support has been broken. Remember, in a market there are buyers and sellers. There is stop hunting, liquidity, short squeezes, momentum spikes, shock events. The price action doesn't have a mind of its own. It's the collective mind, the push and pull of supply and demand created by emotional, rational, and irrational players in the market. The market isn't perfect, so don't expect the movements of price to respect some perfectly straight line. Let's analyze this chart. Where does the breakout really occur? Where is the resistance? Is it at a very strict straight line, or is it somewhere between these lines that grow wider over time? The point is, if you were to make buying or selling decisions based upon a thin line, you might get faked out by a move that goes above or below, thinking the line has been violated, when in reality it has not. So don't expect perfection on the charts that you trade. This is one of the reasons to trade small and use proper position sizing, so you can give the trade some flexibility to breathe. In technical analysis, market reversal is a well-known concept and the basis of many trading strategies, but many traders don't actually know how to analyze a reversal. Price action doesn't just stop and turn on immediately in the opposite direction. This is a rare case. The market always has momentum and will almost always continue beyond the candle or the candle pattern, which is signaling a potential reversal. The problem with many technical traders is that they often become very excited whenever they see a trading signal and they enter a position immediately, only to see the market continue on for a while before the signal was validated. Let's take this example of an uptrend where the market was increasing over a period of several up candles. At this point, you begin to see signs of potential selling coming into the market. The buyers are being overwhelmed by the sellers. However, they are not overwhelmed immediately within the price action of the candle. The market never stops dead and reverses. It always takes time for all the sellers or all the buyers to be wiped out. And it's the constant movement which creates the sideways congestion price zones that we often see after an extended trend move, higher or lower, accumulation and distribution zones in Wyckoff terms. The moral here is not to act immediately as soon as a reversal signal appears. The reversal will come, but not instantly from one signal on one candle. Have you ever waited for a trade? The setup was perfect, where everything was exactly as you wanted. All indicators on the chart are telling the same thing. And then you enter, only to find out that you waited too long, and most of the gains had already occurred. This happens to me, and I'm sure it happens to you. You overlay technical indicators and then look in the past on the chart to see how obvious the buy and sell signals were, but they weren't so clear and perfect at that time though. When you wait for the exact perfect time, when every indicator perfectly aligns in your favor, more often than not, it's too late. If your technical analysis process consists in just clicking buttons because a few indicators said it was time to buy or sell, you're doing it wrong. Relying solely on indicators without first learning how to read price action is a major mistake. I'm not saying that technical indicators are not useful. The issue is that many traders abuse them. They add two moving averages and take crossover signals without understanding the process. They don't even know why they are buying or selling. You can add one or two indicators, but not until you fully understand what's happening with the price action on the chart. Otherwise, you won't know if they're actually adding value or if you just like them because they look cool on the chart. There is often a huge argument underway between technicians who think price action is the best way of analyzing the markets and the traders who think using technical indicators is the best way to trade. Price action technicians say price action is better because it doesn't lag behind the market action. Indicator traders state that their method is simpler because it's a more objective trading style. So which one is better in technical analysis? First, you already know that most indicators are lagging. An indicator takes past price action and then visualizes the result after applying a formula to it. Thus, what your indicator shows you is a result of past price action. But at the same time, price action signals can also lag, or better said, can offer late signals. Trading price action is not as easy as it sounds, and lots of components often get overlooked, such as the size of candlesticks and the price swings, how they compare to previous price action, the component of momentum, and the volatility in the wicks and bodies. Don't make the mistake of trading price action because it looks simple. A trader who doesn't understand the nuances of price action can easily read charts in the wrong way. The same is true when trading with indicators. If you apply 10 oscillators and 10 moving averages to a chart, you can quickly clutter up your screen. Remember that trading indicators are derived from the past price action, so they don't show you information based on what's happening right now. They show you information based off what's happened in the past. The truth is that traders who make all of their decisions using indicators will always be late in reacting to changes in the market. But in this age of algo trading and expert advisors, indicators cannot be completely ignored. The most common issue is that they are lagging, but this can be taken care of if you know how to combine price action with indicators. Indicators are still useful because they provide reference points on plain charts, and decision-making becomes harder with no reference points. Indicators take out the guesswork by providing information that is totally objective. Especially beginner traders or traders who are struggling with discipline can benefit from indicators. Some indicators work best in trending markets, and others work best in range-bound action. Using a trend-following indicator is a recipe for disaster if prices are bouncing back and forth between clear support and resistance levels. Trending markets tend to offer a very high number of overbought or oversold signals on indicators designed to trade directionless markets. This will put you on the wrong side of the market, and you usually won't get a reversal signal until losses have become very significant. And here lies the problem. Most traders never look at the indicators they are using, and they don't even know the formula the indicator uses to analyze the price. Then they use their indicators in the wrong context and wonder why they don't work. If your technical analysis consists in waiting for an indicator to go into the overbought or oversold area, or if you just wait for a crossover on the MACD as a signal, indicators will not work for you. Indicators are tools you use to analyze price information, and as the name suggests, they indicate certain aspects about a chart situation. If you want to identify potential high-probability trade scenarios, you must learn to listen to what the price is telling you. Who is in control right now? Are buyers or sellers pushing price up stronger? How do trend waves relate to each other? Is momentum gaining or losing strength? How is the price reacting around previous highs and lows? Those are all important clues that will help you understand the buyer and the seller dynamic. A divergence on your RSI, for example, just tells you that the most recent price move was not as strong as the previous one, but it's not a signal to go short immediately. A bearish engulfing pattern just tells you that there was more bearish activity than previously, but is not a guaranteed sell signal. A head and shoulders pattern just shows you that the magnitude of highs and lows has changed, and that buyers weren't able to push price to new highs. But it doesn't mean that you have to short each head and shoulders pattern you come across. Context and confluence is what matters in technical analysis. Collecting clues and combining them in a meaningful way is the way to go. Hunting for signals is not what trading should be. There are two types of technical analysis: predictive and reactive. Predictive technical analysis tries to see what the market will do in the future based on the current patterns on the chart. Reactive technical analysis uses current signals in the price action or indicators for buy and sell decisions to create good risk-reward ratios and to go in the direction of the current trend. Predictive traders will establish a position when a technical price level is reached, a Fibonacci extension, a moving average, a pivot point for example, regardless of the price action that occurs at that level. In this example, a bearish candle formed just above an increasing 50 simple moving average. In this area, we also have a pivot level. Many predictive traders established long positions here because an increasing moving average and the pivot level provided a level of buying pressure. The next day, the price moved up and closed higher. There was no buy signal there for a reactive trader. That's the difference between reactive and predictive technical analysis. Reactive traders don't try to anticipate and predict. What they do is try to react very quickly when price begins to move or they get a signal. Reactive traders also try to beat the crowd, and they try to time their entries and exits with much precision. Reactive traders have a desire for quick action. They want their money to be as active as possible. It requires a much more aggressive approach to be a reactive trader. When using technical analysis, you need to contemplate about the difference between being reactive and predictive. What kind of style you're using. If you have a bias in one direction or the other, try to understand why you prefer that way. Many people tried and are still trying to quantify technical analysis and turn it into a science. But the reality is that price charts are open to interpretation by the observer. One technical analyst will think a particular pattern is bullish, while the other will see it as bearish. You know the classic joke: if you ask 3 technicians what the price is revealing, you will get 4 different replies. Despite many efforts to make technical analysis objective, it remains a subjective endeavor. Charts are open to interpretation and are not objective. And that's the beauty of technical analysis, and the reason I enjoy trading. Each person is free to use any approach, any way they want. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.